You're tired in a way that sleep doesn't fix. Not the kind of tired that comes from working too hard or staying up too late or pushing yourself beyond reasonable limits. Not the stress of an empty bank account. This is different. This is the tiredness that comes from owing money you can't see shrink, from making payments that feel like they disappear into nothing, from doing everything you were told to do and somehow ending up behind anyway. It's the weight of logging into a portal once a month and watching a number that barely moves. Sometimes it grows. You make payments and the balance is higher than it was last year. If you have student loans, you know this feeling. And if you don't, you've probably watched someone you care about carry this burden. There's a specific kind of guilt that comes with student debt, not the guilt of reckless spending or bad decisions. The guilt of falling behind while doing exactly what you were supposed to do. You went to school, you got the degree, you're working, and yet the balance is still there. Sometimes it's grown. Other debts end. Credit card debt, you can pay it down, you can see it shrink, and if everything falls apart, you can declare bankruptcy and start over. Car loans finish, mortgages eventually close. Even medical debt, as crushing as it can be negotiated, settled, or, in the worst cases, discharged. Student loan debt doesn't work that way. It follows you for life. Let me show you what I mean. And I want to be clear from the beginning. This isn't about whether student loans are morally right or wrong. This isn't about whether college is worth it, or whether you made a mistake, or whether the system is fair. Those are different conversations. This is about understanding why this particular kind of debt operates differently from every other debt you'll encounter in your life, why it has different rules, why it behaves in ways that seem to defy basic economic logic. Because once you see the shape of it, you can't unsee it. Think about how normal debt works for a moment. You buy a car, you take out a loan, the car is collateral. If you can't pay, the bank takes the car back. That's the deal. You lose the car, they lose the remaining debt. The relationship ends. It's brutal, but it's finite. You buy a house, same principle. The house secures the loan. Foreclosure is devastating, but it's a conclusion. The debt attaches to the property, not to your identity across time. Even credit card debt, the most predatory mainstream lending most people encounter, even that has an exit. Bankruptcy exists specifically as an acknowledgement that sometimes debt becomes impossible to repay, and when that happens, there needs to be a way out. Not an easy way, not a painless way, but a way. Student loans don't work like that. There's no collateral to take back. The education is already in your head. They can't repossess your degree. They can't foreclose on your diploma. The knowledge is yours whether you pay or not. So instead, the debt attaches to something else. It attaches to you. Not to what you bought. It attaches to you, to who you are, your earning capacity, your future income, your capacity to exist economically. The loan follows your tax returns. It tracks your employment. It waits. This isn't a metaphor. Federal student loans have legal mechanisms that other debts simply don't. Wage garnishment without a court order, seizure of tax refunds, offset of Social Security benefits. In many states, they can suspend your professional license, the very credential you went into debt to obtain, if you default. Think about that structure for a moment. The thing you borrowed money to get can be taken away if you can't pay back the money you borrowed to get it. Other debts end through failure. This one just recalibrates. Now, you might be wondering, how did we get here? When did this become normal? The answer is slowly, without headlines, while attention was elsewhere. In 1976, Congress amended the Bankruptcy Code. Before that year, student loans could be discharged in bankruptcy like most other debts. The change was modest at first. You had to wait 5 years after entering repayment before you could discharge educational loans. The logic was straightforward: prevent people from graduating and immediately declaring bankruptcy with no intention of repaying. Reasonable enough on paper. In 1990, the waiting period was extended to 7 years.
In 1998, it became 10 years, and you had to prove undue hardship, a standard so vague and so difficult to meet that most bankruptcy attorneys won't even try. In 2005, private student loans were added to the same protections. Now, even loans from private banks, loans that behaved like consumer debt in every other way, became nearly impossible to discharge. Each change was small. Each was administrative. None of them felt like a turning point while it was happening. But look at the pattern. Over 3 decades, student loans went from dischargeable debt to something closer to a permanent obligation. Not through one dramatic legislative moment, through incremental adjustments, each one extending the reach a little further, each one making exit a little harder. And here's what makes it strange. These protections were created to shield the federal government and lenders from loss, but they don't behave like typical creditor protections. Most debt instruments have discharge mechanisms because creditors know that extracting payment from someone who literally cannot pay is expensive, inefficient, and often impossible. Student loans rejected that logic entirely. The system operates as if repayment is always possible regardless of circumstance, as if there is no level of hardship sufficient to justify release, as if the debt is not just a financial obligation but something closer to a permanent condition. Let me take you through the last few years because they reveal something important. In March 2020, as the pandemic took hold, something unprecedented happened. The federal government paused student loan payments. Not just interest, the payments themselves. For the first time in modern history, millions of borrowers stopped paying and their balances stopped growing. At first, the pause was supposed to last a few months, then it extended and extended again and again. For more than 3 years, most federal borrowers didn't make payments, and something strange happened during that time. People started to breathe differently. Not because they suddenly had extra money, though some did, but because a specific weight had lifted. The background hum of owing, the constant calculation of payment dates and balance growth went quiet. Many borrowers began to imagine a future where the debt just ended, not through repayment, through cancellation. The language of forgiveness entered mainstream conversation. Relief felt possible, maybe even imminent. There were attempts, plans announced, dollar amounts proposed, $10,000, $20,000, applications opened briefly. Millions of people applied, filled out forms, waited. Then the courts intervened. Plans were blocked, applications closed. The forgiveness that seemed so close evaporated, and in the fall of 2023, payments resumed. The whiplash was profound. Not because of political disagreement, though there was plenty of that, but because of the emotional arc. Hope introduced, hope sustained, hope deferred, hope removed, and then the return to normal. But here's what matters. Through all of it, through the pause, the proposals, the court cases, the resumption, the structure remained intact. Different administrations changed the timing, they changed the messaging, they changed who could access relief and under what conditions, but the fundamental architecture stayed the same. Student loan debt still can't be discharged in bankruptcy. It still follows your income. It still attaches to you, not to an asset. The mechanisms that make it different from every other debt, those didn't change. The system bent. It paused. It offered glimpses of something different, but it didn't break. Let me tell you what that means in practical terms. Student loan debt isn't designed to be paid off quickly. It's designed to follow. Look at the repayment structures. Income-driven repayment plans that stretch for 20, 25 years. Balances that grow even while you're making payments if your income is low enough. Forgiveness programs that exist on paper but require such specific, sustained compliance that most people who start them never finish. This isn't accidental. It's not a bug. It's how the system was designed to function. The original logic of student loans was simple. Education is an investment in future earning capacity, so debt secured by that future capacity makes sense. And for a specific kind of borrower, someone entering a stable, well-compensated profession, that logic holds. But the system scaled far beyond that original logic. It scaled to include people borrowing for degrees that don't lead to stable employment, people borrowing from institutions that closed before they graduated, people borrowing for credentials in fields where compensation never risen to meet debt loads, people borrowing again and again for graduate degrees, for retraining, for career pivots that didn't work out. The loans kept flowing regardless of outcome, because the risk wasn't shared. If you borrow money to start a business and the business fails, your lender takes a loss. They bet on you, you failed, and they absorb part of that failure. If you borrow money for education and can't find work in your field, the lender loses nothing. You still owe. The debt still accrues interest. Your inability to repay is your problem alone. This is what makes student debt structurally different. The lender has no incentive to assess risk accurately because they bear no risk. The borrower assumes all of it before they're old enough to rent a car in most states, before they have meaningful financial literacy, before they have any way to assess whether the investment will actually pay off. And once the debt exists, it persists through job loss, through illness, through career changes, through recessions, through life simply not unfolding as planned. It waits. You start to see the shape of it now. Student loan debt changes how you move through time. It affects career decisions in ways other debts don't. You can't take the lower-paying job that aligns with your values because the payment is due. You can't take time off to retrain or pivot because the interest keeps compounding. You can't take the entrepreneurial risk, the creative leap, the geographic move that doesn't come with guaranteed income. Not because you're irresponsible, because the debt is structured to require consistent income, and consistent income requires you to stay on predictable paths. It affects family planning. Marriage becomes a financial calculation. Whose loans, whose income, how repayment plans interact. Having children gets delayed, not because you don't want them, but because the math doesn't work yet, and yet keeps extending. It affects where you live because you need access to higher-paying labor markets. It affects your relationship with risk because risk requires a cushion you don't have. Over time, student debt doesn't just take your money, it takes your capacity to imagine alternatives. And here's the part that extends beyond individual borrowers. This reshapes entire economies. When millions of people are funneling hundreds of dollars a month toward loans instead of toward consumption, business formation, housing, investment, that's not just a personal problem, that's a structural drag. When entire professions become economically unviable because the debt required to enter them can't be serviced by the profession's income, teaching, social work, public service, that's not just unfair to individuals, that's a misallocation of human capital at scale. When the expectation of debt becomes so normalized that 18-year-olds sign promissory notes for 6 figures without understanding what that means, that's not just a failure of financial literacy, that's a system that requires financial predation to function. Even people without student loans live inside its consequences, because the economy you're navigating, the labor market you're entering, the communities you're part of, they've all been shaped by this. Maybe you're watching this late at night. Maybe you just made a payment and felt that familiar heaviness. Maybe you're not even in the United States, but you recognize the pattern forming in your own country, the way education costs rise, the way loans become necessary, the way the promises made don't quite match the outcomes delivered. If this feels familiar, if it's naming something you've carried quietly, you can support the channel by liking or subscribing. It helps a lot.
I want to be clear about something before we finish. This isn't about blame. It's not about whether you made the right choice going to college, or choosing your major, or taking out loans in the first place. Those are personal decisions made under specific circumstances, with the information available at the time. This is about understanding the structure you're living inside. Student loan debt is often framed as a personal failing. You borrowed it, you owe it, you need to pay it back. That framing treats it like any other debt. But it's not. It's a debt that can't be escaped through the normal mechanisms. It's a debt that attaches to identity rather than assets. It's a debt that was designed through decades of incremental policy changes to persist. Other debts have exits because the system acknowledges that sometimes circumstances make repayment impossible, that sometimes the best outcome for everyone is closure, even at a loss. Student loan debt rejects that acknowledgement. It operates as if repayment is always possible, always justified, always the borrower's responsibility, regardless of circumstance. And that changes what it is. It's not just a financial obligation, it's a relationship that extends across time, a background pressure that shapes decisions you don't even realize you're making, a condition that persists long after the education itself has faded into the past. So what is student loan debt really? It's the thing that follows, the thing that reshapes time, the thing that outlives intention. It's the financial obligation that behaves like something more permanent, the investment that became a condition, the promise of a better future that came with a price that doesn't stop compounding. And the strange thing, the thing that sits with you once you see it clearly, is that no single person designed this moment. No villain crafted this system from scratch. No conspiracy created this outcome. It emerged through incremental decisions, through policies that made sense in isolation, through problems solved one at a time without anyone looking at the whole picture. And that's why it holds. Because systems that evolve slowly, without dramatic turning points, without clear authors, those systems are the hardest to change. They don't have a single point of failure. They don't have a moment you can point to and say, that's where it went wrong. They just are. And you're living inside them. Student loan debt is different from every other debt because it was built to be. Because over decades, through small adjustments and quiet extensions, we created something that doesn't end through normal means. Something that waits. Something that follows. Something that most people carry until it decides to let go, not the other way around.